Hello and welcome back to Never Change. Here I intend to go through my Intel analysis. So what is Intel? Well, unless you've been living under a rock for the past 30 years, you should kind of know what Intel is, but if you don't, so Intel was incorporated in Delaware. Intel supplies microprocessors for computer system manufacturers such as Lenovo, HP, Dell. Intel also manufactures motherboard chipsets, network interface controllers, integrated circuits, flash memory, graphic processors, embedded processors and other devices related to communications and computing. And it's also famous for the x86 series of microprocessor, which is found in most personal computers. Founded in 1968 in Santa Clara, headquartered in Santa Clara, California, US, and has approximately 110,000 employees and an annual revenue of $77.8 billion. And its new CEO, as of the 15th of Feb 2021, is Patrick Gelsinger, who is very well known in the industry and has been brought in to turn around Intel. Competition is fierce. So AMD compete with them on the processor front. Currently have the performance crown. Nvidia is looking to compete with them, especially with their acquisition of ARM, if they can get it through the regulators. So Intel could use some help. The once dominant chip maker for PCs and servers is facing challenges from all directions. While manufacturing stumbles have hamstringed Intel's own chip improvements, stuck on 14 nanometer, can't deliver their 10 nanometer. AMD is grabbing market share of the processor market. Nvidia is looking to buy a rival, which is ARM, to bolster its own position in processor chips. Apple has defected from Intel to chips of its own design, and perhaps inciting Microsoft to follow suit. Meanwhile, big cloud servers at Amazon and Google are developing their own chip servers to displace Intel as well. So Intel is facing competition on all sides. So let's go into the analysis. Let's see where they're at. Credit rating, so no problems here. Moody consider them A1 and S&P consider them A+, so low credit risk. Common size analysis, few things to worry about here. So revenue, nothing to worry about, trending up in the right direction. Cost in goods and services, slight issue here, it is trending up, which is impacting gross profit. Don't know why this is happening, mainly probably because they're throwing as much money as they possibly can on getting their 10 nanometer out, which has impacted goods and services, hazard a guess. Also, a few good things to point out as well. So even though the revenue is going up, the operating expenses is trending down. Huge amount of money is being invested in R&D. It's hovering around on average the 20% mark of revenue, which is really good. Huge amounts in R&D. So it currently sits at $13.5 billion per annum, which is far in excess of the competition. Far in excess. And another good thing to point out here is their free cash flow. So their free cash flow has gone from $10 billion 4 years ago to currently sit at almost $21 billion. So huge increase. Analysis consensus of EPS targets. They've either beat them or met them over 2020, and as of filming this, I believe they've also beaten the Q1 2021 target, and financials, as you can see, are all trending in the right direction. Moat analysis, so I was able to get 4 years worth of data. So trending over the past 4 years, EPS has increased by 25%, OCPS has increased by 13%, and book value per share has increased on average by 37%, so all above that 10% that we're looking for. Revenue hasn't met that 10% that we're looking for, but it's still a huge number. at $77 billion. So it has increased from 4 years ago, sitting at $62 billion. So yeah, nothing really to worry about there. How are the management doing? So return on equity sits at 26%, far greater than that 10% we're looking for, and return on invested capital sits at 18%. So again, far greater than that 10% that we're looking for. Debt to earnings ratio currently sits at 1.62 years, far less than the 3 years that we're looking for. So all looks rosy on the invested capital and debt front. Margin of safety, right, so where should we enter this stock? Okay, so in the model I put earnings per share trailing 12 months at $4.49. The analysis consensus of growth rate at 12% and future PE multiplier of 13.78. Minimal acceptable return to us at 10% would give a sticker price of $81.51. So 25% margin of safety on that would be to enter this stock at $61.14. So this at the moment is saying that this stock is undervalued. So it should be up around the $81 a share. I mean, there's margin for error in here, and I'm only using an analysis consensus of projected growth rates and PE multiplier. But still, you know, even at a 25% margin of safety, to go in at $61, I believe is a safe bet. Or you could wait for a 50% margin of safety and try and go in at around $40 a share, which could possibly happen due to Biden, a rumour that Biden is going to increase capital gains tax by double, which has caused a bit of a sell-off on the stock market. So anywhere between, you know, if it drops below $61 a share on Intel, I believe that is probably a bargain. See how the foundations are. So 8-pillar analysis. So I have it passing 8.5 of the 8 pillars based on a share price of $64.75. It's actually slightly cheaper than this as at the time of filming. Which would give a market cap of $263 billion. PE ratio currently sits at 13.11, profit margin 26.84. Yes, the revenue is growing, no, profit is flat. They are decreasing their shares. The liabilities is only 47% of their assets. Free cash flow is growing at an average about 24% per annum, which is really good, and price to free cash flow currently sits at 12.52. So really it does look like a good buy. So again, putting that back through at 25% margin of safety, so based on a $61.14 per share, outstanding shares at 4.07 billion, based on the 25% margin share price would give a market cap of 248.3 billion. So their free cash flow, which currently sits at 21.1 billion, would give a PE ratio of 11.88 and a price to free cash flow of 11.76, which, you know, I think is an absolute bargain for this company going forward, and I will go on to why I think that is. So why I think that is there's currently a huge chip shortage in the world at the moment. There is no or very little semiconductor fabrication space anywhere in the world, and that is having a knock-on impact. I know car manufacturers like Jaguar Land Rover, for example, have halted production of their vehicles because they cannot get chips. There's a global shortage of GPUs. Yeah, anything that you can take those chips in is currently under threat. So Intel is planning to spend $20 billion on building 2 new chip plants in Arizona. yes, it takes a long time to get these chip plants up, running and tuned in, but this problem is not going away anytime soon, and if anything, it's going to get worse. So Intel is primarily positioning itself to capitalize over the next couple of years on this problem. Also, they've got lots of new products in development, and they are a diversified company. They have their fingers in a lot of pies, and they're also making huge gains into the GPU space, and they're currently released a discrete GPU, and they're looking at releasing a performance GPU which could rival the competition. One thing that I think is also overlooked on this stock is Intel has a huge bank account. It can throw a lot of money at the problems it's facing at the moment if it's willing to spend, and as you can see from the 20 billion on the 2 new chip plants, it is willing to spend. And it's also heavily investing in 5 nanometer in which they plan to release in 2021, and 3 nanometer R&D that they plan to release in 2022 with TSMC. Also, good to point out that this is a dividend stock, and with Biden's rumored new capital gains tax doubling, if they can actually get that through Congress, there's no rumor at the moment around a dividend tax increase. So I see a run on high yield dividend stocks. So this isn't generally a high yield dividend stock. It sits at around 2%, but it's still a dividend stock. And if they don't increase the tax on dividends, then I think the market might shift in that direction. So limiting factors on growth. So Intel is struggling against the competition at the moment. I've got a few slides next to show that. They've been stuck on 14 nanometer since 2019. 10 nanometer transistor CPUs have always been, yes, they're coming, and never quite released. I do believe they're planning to release them at the back end of 2021, but that's so late compared to where they should have released them. Google and Amazon are both designing their own server chips, as mentioned before, and Microsoft has announced it will manufacture its own ARM-based chips. So this will have an impact because Intel absolutely dominates the server and corporate PC networks at the moment, at about 90% market share, based on my research. Intel will very, very much be on the defensive now. Also, Intel has been hit with a huge patent infringement ruling to the tune of $2.18 billion. Ouch. So this has taken them completely by surprise. So 2 patents that have not been used in the last 10 years, VLSI, I don't really know who they are, have come to Intel and said, right, we would like $2 billion because you've used 2 of our patents. And it's been ruled that yes, even though the patents haven't really been used in the last 10 years, Intel is at fault and owes VLSI $2 billion. Ouch. So this equates to 1/10 of Intel's net income. And then also mentioned before, ARM's acquisition, Nvidia's acquisition of ARM, if they can pull it off, if they can get it past the regulators. So as promised, just to show what roadmaps were released years ago and their intent. So Intel had planned to release 10 nanometer in 2019, 10 nanometer plus plus in 2020, and 10 nanometer triple plus in 2021. And also at the same time release the 7 nanometer chip. They didn't manage any of that. So they will only be releasing 10 nanometer at the back end of 2021. Meanwhile, the competition on the AMD side, they released 14 nanometer 7 nanometer and the next generation of 7 nanometer, and are on target to release 5 nanometer before the end of 2022. So Intel are very much playing catch up. And so why is that hurting market share on CPUs? So if you go on the performance side, so this is an example of a multi-core benchmark recently taken. You can see that Intel only occupies one of the top 5 performance spots. All the other 4 are occupied by AMD. So in conclusion, the credit analysis fine, common size analysis was okay. There was a couple of areas of concern, but I don't think in the long term it should be fine. Moat analysis was okay. Return on equity, return on invested capital, okay. No issues regarding long-term debt, and 7.5 of the 8 pillars was passed, so no problems there. So Intel has good growth potential going forward. It's positioning itself very well to dominate on the or take advantage of the global chip shortage. It does face a lot of risks and competition, lots of risks from its competition, but it has very deep pockets, and it can almost buy itself out of any situation or issue that it faces in the near or long term. And it's also heavily investing in the long term. So as I said before, per annum it invests $13.5 billion in R&D per year. To put that in perspective, AMD manages 2 billion. So at some point that is going to pay off. So current share price at the time of filming this is $64.71, which is probably about right. And so I would say for using a 25 to 30% margin of safety, a good share price to go in at would be between $55 to $60, which with current events we could possibly be seeing soon. So I have a bit of cash set aside to buy a dip opportunity. So what do you think of Intel? Are you also quite bullish on this company? Do you also think it's a little bit undervalued at the moment? Yeah, I think there's a lot of hype around AMD and Nvidia, and Intel's almost been forgotten a little bit, and I believe this is a sleeping giant ready to wake up. Am I missing something? Yeah, please let me know. Also, if you enjoy the content, please like the video. It helps me grow, and subscribe, please, if you get anything out of these videos, or if you have any suggestions of how to improve them, or any companies you think would be worth to analyze. Yeah, so hopefully see you again soon, and thank you for stopping by. Goodbye.